The next section of today, which is about investment ready. So I'd like to welcome the whole panel onto the stage. So, dear audience, what will this panel be about? Well, the panel will offer advice and insights on targeting the right investors, finding additional value through connections, and providing insight into the future of investments. And it will also discuss the future of the investment sector and how this actually impacts economies. So let's get started with this session. We have here Lucy Rance, Associate at ETF Partners United Kingdom. We have Yigal Ehrlich, Founder, Chairman and Managing Partner of the Yosma Group, Israel. We have Stephen Welton, CEO of Business Growth Fund, United Kingdom. Beverly Gower-Jones, CEO of Carbon Limited Technologies, United Kingdom. Last but not least, James Nettleton, Principal at Downing LLP, United Kingdom. Thank you so much for joining us here on stage. And I think we're going to have a very interesting discussion about are companies actually ready to invest, and it's also up to your judgment to say if they are ready, yes or no. So I'd like to ask all of you just to give a small input statement of about 2 minutes and to also elaborate on the question, why do you want to help companies, promising companies, to grow? So, if I may start with you.
Sure.
Yeah.
So James Nettleton from Downing Ventures. We're a generalist early stage technology investor. But my career in venture capital and also my role at Downing is kind of anything but generalist. I spent the last 3 years managing In Motion Ventures, which is Jaguar Land Rover's venture capital fund, focused on transport and mobility. And now at Downing, my investment remit is very much focused on the future of cities. So for us, that means the future of real estate, how people buy, sell, and experience property, the future of connected infrastructure, how we kind of quantify and understand the built environment, and then the future of transport and mobility, which is everything from autonomous vehicles to ride-hailing and everything in between. And I think that gives you a clue as to why I'm in this business and why I enjoy working with high-growth companies. And for me, it's less about the kind of general promise of technology and the general process of investing. For me, I've always been passionate about urban innovation. And my focus as an investor is working with entrepreneurs who are passionate about making cities better places to live, cleaner places to live, and helping them achieve that through their companies and making money in the process.
Okay, so innovators have the passion for their innovation, and you have a passion for supporting the right companies.
Absolutely.
Okay, Lucy.
So hi, my name is Lucy Rance. I'm with ETF Partners, which stands for the Environmental Technologies Fund, which is sort of self-explanatory. We are a sort of later stage VC for fast-growing, sustainable technology companies. We're a smallish team, we're about 12 people based in London, and we're investing across Europe. And we think it's a fantastic time to be in both VC and sustainability. The world is changing, and where there's change, there is opportunity, and I guess that's a big part of what this conference is about. So we're looking at how our cities are changing, we're looking at how the industrial world is changing, and we're looking at how the world of energy is changing. And we're then trying to find the best companies that are making that happen and investing in them. My personal background is in material science. I joined the team at ETF about 3 years ago. And for me, why I enjoy helping these types of companies grow is 2 points. There's the sustainability point, that I really believe that one of the most important ways to tackle climate change is innovation. It's a personal belief that we don't have to sacrifice growth to fight climate change. That's maybe a separate debate. But also, it's a huge privilege to work with entrepreneurs and be invited in and be part of their companies.
Okay, thank you. I think we've already got 2 keywords that we can pick up on later on: innovation, sustainability. Beverly.
Hello, I'm Beverly Gower-Jones, CEO of Carbon Limited Technologies. I established the firm 13 years ago. We're the most established clean tech incubator in the UK. We provide consulting services to SMEs intent and focused on clean growth. And of course, a large part of the decarbonisation agenda is all around technology and the impact that technology can have to decarbonise our different market sectors. I really enjoy working with entrepreneurs to help them encourage and grow because it's a journey of technology commercialisation, is a journey of co-evolution. What I mean by that is there are a number of different actors that actually have to come together for something to be commercialised and hit scale in markets. So the infrastructure needs to be there, the market potential needs to be there, the technology needs to be in the right place, and the investment needs to be there too. And that journey of co-evolution is extremely complex. And so our networks and our contacts and our ability to actually help SMEs on that journey and watch them succeed is extremely fulfilling.
Okay, thank you. So it's all about the journey. Okay. Yigal.
My name is Yigal Erlich. I'm from Israel. I started my career as a researcher in the university. Then I became a government official as a chief scientist of the Ministry of Industry. After that, I established the Yozma Fund, which was a government fund. Israeli government fund was the initial of the venture capital in Israel. We privatized it after 5 years, and since then I became a private venture capitalist. Today, we are not anymore a fund, a normal fund, but more as an angel fund. We like, of course, to invest in people. Entrepreneurs is the most important to work with. That's what I did the last 30 years. But frankly speaking, main target for our investment as venture capital is to return money. So we are looking for profits. We are looking for making money, working with people. If we can help society by our investment, it's good. And if I help myself, it's very good. And thank you.
It's a win-win situation. Very good. Stephen.
Good afternoon. It's a pleasure to be here. I'm the founder of the Business Growth Fund. We are now 8.5 years old and are now the largest investor in growth companies in the UK. We have 13 offices across the UK, 1 in Ireland, and we've helped to establish a business in Canada, and Australia is also looking at replicating what we are doing, which is to create a very large-scale way of deploying growth capital into a broad range of businesses. We are now investing close on £500 million a year, and we have a portfolio getting towards 300 companies, and we've invested almost $2 billion. And I think in the context of what we're focusing on here, I would sort of pick up a theme of scaling up. I think there is undoubtedly a lot of innovation in terms of companies here. There's a lot of innovation in the UK. Are we doing a good enough job in translating that innovation into true scale-up successes? And I think therein lies a really interesting debate as investors, and clearly the successes that we achieve there will help to transform society in key technologies and industries.
Okay, thank you very much. And ladies and gentlemen, don't forget to ask your questions via Slido. We have one question that already came in, and we'll tackle that in a second. However, I'd like to start with a first question for Lucy, perhaps. I also had a look at your beautiful website as well, where you say you spot investment opportunities and sustainability applications that others miss. So my question is, how do you go about to find the pearls that really can change the world?
Yeah, good question. I'd say, first of all, to my point earlier about sustainability being a really exciting space, I'd say, first of all, it attracts some really fantastic entrepreneurs anyway, and some really fantastic companies. And I think that sense of responsibility that attracts someone to that space maybe also filters down through the rest of the business. So you end up with some really strong businesses in that space. So first of all, that's maybe a cheat answer, but just by being in sustainability, I think we find some great companies. And then I guess it's all about the people. So yes, we want to find great technologies, but to do that, we have to find great people, and those great people have to find us. So it's a mixture of those. And the way that we get people to come to us, I guess, is mostly around reputation. So we work on building our image and building a reputation, so how we treat people is very important. Venture capital can sometimes have a slightly negative reputation. People can think it's aggressive, that they're trying to take your company off you, all about returns. So we We try and treat people fairly. We try and be nice to them. We try and reply to them if they approach us, which is a really important point, I think. We try and connect with a wide variety of people. So to do that, we kind of have to have variety within our team. So that is nationalities. So we're mostly focused on Europe, so we have a bunch of European nationalities. And also age diversity, which I can say because no one else from my team is here, but there are some more experienced people in the team who've been around for longer who can connect to the more industrial, sort of more experienced entrepreneurs. And then myself, I hope you can tell I'm on the younger end, and I'm out networking with the next generation of entrepreneurs and the next generation of consumers.
Okay.
So there's that as well. And then maybe my last point, we have to also, we can't just rely on companies coming to us. We have to go out and try and find them as well. And the best way of doing that, we find, is to first build an idea or a thesis around what we think is going to be successful or where we think there's an opportunity, and then go and try and find the best company that's doing that. So, for example, there's been a lot of attention around food waste. So we thought there's a huge opportunity here for someone to disrupt this market and handle food waste, particularly at the retailer level. And we went out and found a French company called Phoenix that are doing that, that are redirecting sort of end-of-life products from the supermarket and giving them to charity. So that's the top-down approach. And then, I mean, sometimes it's completely organic. My strangest deal sourcing story was I was once on holiday in the Arctic Circle on a dog sledding trip, and I got chatting to another lady who was on the same holiday, and she happened to be a founder of a really exciting clean tech growth company.
Yeah. So it can be both strategic and ad hoc. I think you mentioned a very important point that I'd like to discuss with you as well. It's not just about technology or sustainability. What it's really about is the people, right? I mean, you can have any kind of technology, but the team really makes or breaks success or failure. So, Beverly, can you elaborate on that? Have you seen, for example, beautiful technologies, but then the team is completely out of line and there's no way to work with them properly?
I think that entrepreneurs are extremely dedicated and extremely passionate about what they do. And I think the challenge or the trick is to look at things through their eyes and their vision rather than kind of the other way around. And I actually feel, through working with over 400 SMEs over the last 13 years, that a team that is prepared and can take the coaching and the support that's offered by our incubator service can come an awful long way. I know this isn't a generally held belief, but actually somebody said to me a long, long time ago, you can mentor people and you can change people if you have to, but if you've got a dreadful technology, there's not a lot you can do about that. So I'd rather come from the other viewpoint, actually, that it's the technology you really need. It really needs to be disruptive, and it really needs to have that competitive advantage, and you can build everything else around that.
Okay, so you need all those ingredients in order to be successful. Yigal, what's your take on that? Because you've been in the business for such a long time, so you've seen a lot.
Well, if you ask about choosing investments, the people, of course, is the most important thing. But how you judge the people when you go to make an investment, it's an art, it's not easy. First of all, you look at the team. The team should have a chemistry, and you can check it very fast. If they work together, how long they worked before, and if they can divide or distribute the work among them. It's very important. Second thing, of course, is except the chemistry, is the flexibility. How much flexible are they going to be? Because entrepreneurs, sometimes they are very stubborn. So if you understand that these people are going to be not flexible to good ideas, maybe it's better not to invest. I'm talking about startup, very early stages.
Okay.
So judging people is very important. But there are other elements, of course, when you come to making investments, and one of them, which I consider to be maybe very important, is the timing of the idea that they are going to develop.
Okay, thank you.
It's very difficult, again, to judge if they are coming out, before the market or after the market is there. It's very difficult, and it needs some experience and more.
Okay, thank you. Then I'd like to take one question from the audience, which actually alludes to this point. How early in the startup journey will you invest? Stephen, can you elaborate on that?
It clearly will depend on how much capital you're going to try and raise. I think there's a reason that we have friends and family investing at that stage. You're not going to get institutional funding, so you need somebody who trusts your character for a different reason, because they've known you, and I wouldn't underestimate the power of that. I think, as a general point, in terms of raising capital, one thing we need to be mindful of is we're training a cohort of people who are great at pitching, and that is a key skill. If you can't convince somebody to back you, then you're not going to raise capital. But the emphasis has got to be, what are you going to do with that capital once you've actually raised it? And I would come back again and again to quality of execution. The better a business executes, the more likely it is to be successful. And clearly that goes to the combination of team, market opportunity, product. But raising money and getting to a high valuation, or a higher valuation than the last round, is not actually creating anything. It's just creating a wall of capital. What are you actually doing with it? And good companies execute well.
Okay, thank you. What's your take on that, James?
So the factor also, so how early we invest, we will do everything from kind of a couple of $100K, incredibly early, sort of an idea, beginning of a prototype and some initial proofs of concept maybe, right through to much later stage investments. And it's, particularly when you're looking at something that's almost just an idea stage, you then rely even more heavily on the people and then the scale of the market that they're going to. And at that stage, you can do as much analysis as you want, but there's so much uncertainty tied up in it that you're really looking at, like, how deeply are these people engaging with the core of the idea, with the problem that they're trying to solve for the customer. But yeah, we invest very early.
Yeah. So how do you judge on how deeply engaged they really are?
So one thing that I like to do, because I think the point about a generation of people that are very well trained at pitching is incredibly important. I try and not let somebody pitch me until like a third meeting. I don't want the pitch. I basically, which is why quite often we'll try and have slightly more informal meetings. Our first meeting might be in a coffee shop or in a slightly more setting that breaks down that kind of formality a little bit. And then you can get very quickly into the guts of it. So then you just start asking questions, and then you start debating, and you very quickly figure out, like, is this something, is this an idea, or is this a product, or is this a company that somebody's come to because of a really shrewd observation, maybe in their current role or an area of technical expertise, or is this something that's been figured out at business school, like as part of an analytical exercise, but actually doesn't stand up to reasoning? And I think, to your point about execution, it's people with that real depth of engagement who are then able to execute because they're experts, they've thought it through. So I like debate, argumentation, and in the space of an hour, going tooth and nail with someone in a nice collaborative way, you figure out a lot about their depth of engagement with the subject.
Okay, thank you. So innovation is also about risk and failure, and I want to pose the question to all of you. Have you ever misjudged a company, invested in a company where in the end it didn't turn out to be going that well? Does anyone want to dare to take that question?
Silence.
Yeah, I can do that. So I had an example where we invested in. So this is back in my old fund. We're investing in mostly consumer-facing transport and mobility, and one of the areas of transportation, and we were investing in the States, one of the areas of transportation that's been largely untouched is the transportation of children and family transportation. So you have massive companies like Uber and Lyft that are dealing with like my kind of everyday transport, but as we have more and more families where both parents work with multiple children, solving that problem of how do I safely, securely get my kids to where they need to be at any given time can be increasingly challenging. We invested in a company that was, to very crudely describe it, was developing a kind of Uber for kids model with multiple layers of additional safety and vetting of drivers and all of the trust and security along the way. That was a completely new model at the time. We worked with the CEO to look at the regulatory environment they were working with in Massachusetts. We made a huge amount of effort to make sure that the company was living up to essentially the school bus legislation. And then just as we were about to close their second funding round, we were talking to a bunch of journalists. A slightly overeager journalist from the Boston Globe was doing research on the story, called the utilities regulator in Massachusetts and said, "Hi, I just wanted to get your comment on what this company Shepherd are doing, running this kind of new innovative school bus-like service that's kind of more like Uber." And they said, "Never heard of them." And 2 days later, shut them down completely and said, and then the funding round fell apart and we lost some money. But that's one of the risks of genuine innovation.
Okay.
You know, there are risks.
Okay. Anyone else has an example to share? Beverly?
Yes, I will. In clean tech, particularly some of the early stage activities, we see quite a lot of leapfrogging. Because the speed of getting the innovation to market is really key, you do quite often see that something you thought that was going to be a really promising technology innovation gets kind of overtaken quite quickly by something else. And so I'm thinking particularly of things like the price fall of lithium-ion batteries. We had a number of innovation opportunities that in the incubator accelerator that we're running, where their value proposition was all around reduced cost of battery technology through different chemistries. And of course, the price of lithium-ion has dropped so quickly that you know, those other companies, I think their market share has really been very quickly eroded. There's another example in hybrid buses, a firm looking at doing a hybrid engine for cooling so you could continue using fossil fuel. And of course, you know, hybrid buses are now going hydrogen and fuel cell and so on. And so the length of time it's taken that firm to try and get that product to market, it just won't make it in time. And so I think when we look at systemic change of systems, we have to look at competition coming from other places that we wouldn't normally expect it to come from when we look at our competitive advantage and try and stack that up.
Okay, thank you very much. Stephen, final example?
Companies fail because they run out of money. So it's a question of why are they running out of money? And clearly in the innovation stage, you're raising money to invest in technology and people. One of the things that we continually find is a challenge is, of course, sales. Because ultimately, you've got to take an idea and turn it into something that is commercially viable. And there is a lot of rigor around costs because they're easier to predict. Technology is harder, but sales is the most difficult thing of all. And often there is this gap, especially when you're dealing with innovation, between translating an idea into something that works into a marketplace. By and large, most companies are way too optimistic about how quickly they're going to get there, and that leads to a funding gap. And obviously there is an element here of funding rounds. So more understanding of what the buyers of the product or the technology are going to do and the time frame they're going to do it in will help you to make sure that the business is properly capitalized. Yep. Because I should think one of the reasons entrepreneurs are good at pitching is because they're constantly having to pitch to raise more money because they're going to run out of money. So if we could raise more capital earlier on to give them a proper basis to then develop a business, I mean, that's slightly optimistic, but that would give them more scope to actually develop, because the reality is this is an element of a race, and the runways are called runways for a reason.
Can I add to that?
Yes.
Yeah, so to add to that point, particularly around capital-intensive companies, that is a huge challenge. Yeah. When people need X million pounds to build a pilot plant, and that's all well and good when there's a lot of money in the market, but it's those companies that suffer when there's a downturn, which, yeah.
Okay, thank you. I'd like to take a question from the audience, quite an interesting one. Someone is looking for comments on getting private investors interested in companies with technology at lower TRLs, so technology readiness levels, to maximize the effect and impact of government funding and accelerate route to market. Because, well, you normally invest on the higher tier level companies, closer to markets, very innovation prone. But what about those kind of spin-offs that come out of universities, RTOs that have some potential? Do you tap in that world as well?
I think I can maybe contribute to that discussion. I think with the earlier stage technology readiness level innovations, it's obviously important to start with grant funding and funding from angel investors, but it's as key to do what Stephen was talking about earlier, which is maximize the use of the resource and show that you're actually delivering on the plan, even if it's a smaller scale plan at that stage, because the next investors that are going to be coming along after are going to look and see, well, what happened to that initial capital, and was it, you know, wisely spent, and did it follow the business plan that was set out when that money was brought on initially. So it's really about kind of starting the, you know, the way that you mean to go on. In the clean growth space, there is a lack of capital at the early stage. So I did some research, and over the last 5 years, there have only been something like £250 million of money gone into clean growth, whereas for internet businesses, over the 5-year period, that's increased from 200 million to 3 billion. So that's a massive change, that's a massive challenge, and that does need to be addressed. So there is much more capital needed to come into the sector if we're really going to hit the decarbonisation targets. You know, Parliament have just announced a climate emergency, and so the steps and actions that need to be taken to meet the Committee on Climate Change's Net Zero report, with investment and funding is a key part of that. And that really needs to change across the whole funding life cycle, from early stage VC all the way through to infrastructure investment.
Okay, thank you very much. I'd like to come to some of the sectors you are investing in or not. Yigal, can you tell and share with us why you are active in the sectors of communication, information technologies, and life sciences, and not in other sectors?
Well, you know, the venture capital business, it's opportunistic. So you are always looking for the best deal you can find. Now, because we are a local fund, we are looking only on Israeli companies so far. The most important thing is what is the size of the deal flow in a certain area? Or in other words, how many companies you can look at if you want to invest in the best ones. In these areas that you mentioned, the deal flow, I mean, the number of companies in Israel is the biggest. Israelis are expert in developing IT and communication and medical stuff. So it's better to be in this area, to try to gain expertise in this area, and to find the best companies out of many that you have. Now, of course, to find the companies, there is a competition. So I believe there is another question of yours, how you cooperate with other funds. But this is very common, that you do investment with other funds, with other investors in many startup companies.
Okay, thank you. So Beverly, you have a very clear profile, right? The clean growth part, carbon innovation. Why have you chosen this specific sector? Because your experience yourself already from your background?
So when I founded the company 13 years ago, the mission was to focus on early stage clean growth companies. I think we've never faced a bigger challenge than the one we have now, which is the climate change agenda and keeping global temperature warming to 1.5 degrees. And it is technology that is going to deliver a lot of that innovation and a lot of that decarbonisation. We're not going to meet that target without completely radically different ways of working in all our key sectors. So from one standpoint, clean growth is very focused, but that goes across our 5 key sectors. So that's looking at the power industry and how we're going to generate all our power from renewable and distributed resources. It's looking at the transport sector and how quickly can we move to electric vehicles and how do we electrify and build the infrastructure charging that's needed to do that. It's looking at the waste sector and looking at how do we reduce waste, but then how do we reuse waste so that we have a circular economy approach. It's looking at the energy intensive industry sector, how do we help utilize waste heat, how do we move things again to electrification, and how do we really ensure that we keep manufacturing in the UK because it's a core driver for jobs and productivity. And of course, lastly, the building sector. How do we have homes that are fit for the future? Most of the buildings we have in the next 50 years, we have today already. So how do we do that retrofitting? How do we do that insulation? And how do we make those buildings fit for us to live and work in? So yeah, in some senses, clean growth is very focused, but it does attack the biggest challenge that as society we're facing. Yeah. It's an industrial revolution, but it's an industrial revolution under a timeline, and it's the first time we faced a timeline and a need to do something. So I'm quite energized about trying to accelerate the pace of new technology adoption. We don't have 30 years to do this, we have 11. And so we really need some radical action and some big steps to make that change.
Okay, thank you. So actually it's a very horizontal approach that actually cuts through multiple sectors where you try to add value. Thank you for that. Let's take another question from the audience. And it looks like you really like to hear some stories. So do you have a one that got away story? Anything you'd like to share?
Story of success?
You may share a story of success, of course.
We have more failures than successes. But there is one great story about one of the companies that was very successful in our portfolio. It was a few years ago. We invested in a company that nobody wanted to invest in because it was a too old area to invest in such companies.
What is an old area?
It was a toolbar, the toolbars, that appears in the computers long ago. And this company just changed a bit the idea of the toolbars. They decided instead of just putting a toolbar, a new toolbar on the screen, they will create tools in order to enable publisher to use the tool and create toolbars for their audience. So this company started to work. Nobody wanted to invest. We thought that because of the people that were so confident in what they are going to do, we decided to invest. We were the only investor. We put about $2.5 million in the company. We got back 5 years later, $140 million, which shows you what is venture capital for. Right? The size of the fund was only 50. So one company could triple your fund and cover all the failures that you have for and others. So this was a big success. We have had also a big failure. We invested in a company with a great technology, it came from the university, with the best professors in optics. It was kind of a new switch, optical switch. The problem was that the market was ready yet. The infrastructure of optical communication was not ready yet. So we worked with this company and we raised money not from ourselves, from other funds. We invested in this company maybe $30 million. And after 4 years, we realized that the market is too far ahead. We had to close the company. Yeah. Nobody wanted to, to deal with such a kind of optical switch at that time.
Yeah, so you ended up in a point not investing anymore. No. I think then I'd like to ask a very important question to all of you that's also alluding to that point. Well, the founder of Estee Lauder himself said, trust your instincts, and that definitely applies to the innovators. but I'm sure to you as well. I think Yigal, you already gave a nice example. No one wanted to invest in that company, but you've decided to invest in that company. The story can also apply to the story that you shared about something that went completely wrong, where perhaps they might go to other investors to collect money, and then they should be wary about the fact, okay, is this the right company to invest in? So how important are your instincts to make the right judgment? So that's more a question of emotion and feelings, I guess.
I think
Stephen?
if you haven't got passion for what you're doing, whether you're an investor or an entrepreneur, I think you're highly unlikely to succeed because there are so many challenges anyway. I think the interesting thing with instinct is how much do you then validate your instinct? So you're trying to prove a thesis and you've already decided you're going to invest, which is always a little bit dangerous because you're not entirely objective. So I think instinct, I would never ignore instinct, but also you want to make sure that you don't just blindly put everything to one side. But what is great fun dealing with entrepreneurs, everyone I've ever met believes what they're going to do. Now, the reality is very few of them are going to blow the lights out in the way that they anticipate, but they do believe that. And the instinct is that person strong enough to build a team? Because to me, that is the other key element here. One great entrepreneur can be the figurehead for a company, but the team is what develops the business. So something I would always look at is the followership within a business. Can you get a number of people to get behind that instinct and actually to develop a company?
Okay, thank you. Lucy?
Yeah, so this is something we've thought a lot about as a group, because I think when you're making venture investments, you're never going to have all the information. You're never going to, you'd spend years gathering it all. So you have to work with what you have. And then I think gut is really just all the information you've got and the feeling that you have about that. And it's about a lot of the time it's biased by what you've seen before or people you've known from the past. So we believe in gut, but we also believe in bias. So we actually have every time we make an investment, we've created a bias radar that we put in all our investment papers, where we go through all these points and we say, have you seen something like this before? And is it affecting your decision today? And what it does as well is it involves the whole team, so that it sort of reduces the risk of one person's bias or gut getting in the way of something or pushing something through that might not go through. But I do think gut's important as long as it's managed.
You're using calculated instinct.
Yeah,
okay.
Exactly. We actually published a paper on it. It's on our website
really?
if anyone's interested. Yeah, it's fabulous.
Okay. James, any experience?
No, I think that's a really great way of talking about like the complexity of answering that question, actually. I think like instinct plays a really important role. So like if your gut is just telling you there's something not right about the presentation you're getting, about how people are interacting with each other, in those types of environments, particularly when you're trying to make judgments about people, then yeah, gut and instinct's really important. Apart from for the fact that if you're a group of people, and venture capital, for instance, is an incredibly undiverse industry, what instinct can end up doing very easily is just entrenching bias and entrenching prejudice. And so you need to check that. And in the same way that when you look at market size, for instance, which is definitely an art, and the earlier stage of the technology, the more of an art and less of a science. The one thing that you hear all the time, even when you get to investment committee stage, when you're discussing deals, it's just like, oh yeah, it's just, that market's just never going to happen there, is it? And you're never going to have infallible information to argue against that. Yeah. But actually, sometimes you look at something and you think, I would have never believed this market was this size. I would have never believed it, but I've gone out and I've got the data and I've spoken to the experts, and there's always people that are more, however narrowly you invest, there's always people that are more expert than yourself. And they really challenge those kind of instincts. So I think instinct gets you through, but you've really got to check them, partially because you're managing other people's money, and partly because if you don't, you can entrench bias and on all levels.
Okay, thank you. I see there's another question from the audience. What do you look for from businesses who are looking to expand into new markets outside of their home country? Anyone who is willing to take this question?
I can start. I think a lot of British companies, when they think of going international, think of going to America. And a fairly obvious question, why? And you'd be surprised at how shallow some of the answers to that are. It's English speaking and it's a big market, but there are also quite a few companies there already. So I think most companies underestimate the challenge of going beyond their home market, because you go back to the team and you understand your market, you understand all the cultural nuances of the market, you understand your customers, your suppliers. I think this is where technology does become really interesting, because technology is truly global and it transcends national barriers. But I think often starting more modestly rather than trying to conquer the world or have the perfume label, to go back to sort of Estee Lauder or L'Oreal, is a good starting point, because I mean it's often said that America is a graveyard for many British companies, because they failed to translate what they had into the US market. It's very different. So pick the right markets and pick them for the right reasons rather than they seem the most obvious.
Okay, so companies shouldn't be too naive by just...
No, I think it's, this is a small country. It's essential that you look abroad, but then you think, how are you going to do that? And it's not a linear challenge, because who do you put in these new markets? And the obvious route is to take somebody from your home market, but then what happens in your home market? So I think these are interesting challenges, but there's certainly, I think if you're outward looking, which many innovative companies by definition are, they're better placed to do that than many others.
Okay, thank you. Beverly, do you have the same experience? Do you usually tell them, be modest, start within your own home markets, unless they have a really, really good plan how to roll it out to other countries?
We have a number of quite early stage companies that think the grass might be greener elsewhere. And I think the first question that any international market will ask is, well, how successful is it in the home market? And so until you've built a credible track record and a credible revenue stream, you know, in the UK, that is the thing that you need to be able to show and demonstrate that you can be successful internationally. And then, as Stephen says, it's about which is the right market. So we have one company in the biofuels that's now in Brazil, and that makes a huge amount of sense, because you know, having done the research, Brazil is one of the top countries for biofuel generation, and they've built that into their own country, you know, industrial strategy going forward. So it makes a huge amount of sense for that. And I think that's the level of rigor that needs to be adopted, because you need an office, you need the relationships and ties. In many countries, you need local firms to be able to help build the networks and relationships that are required. And of course, you know, the ease of doing business list, there are many companies where it's much, much harder to actually set up and establish than it is in the UK. And so I think there's a lot that we take for granted or don't necessarily fully appreciate until we actually, you know, take that step and try it. It's very expensive, and so, you know, really need to have the depth of resource to be able to embark on that kind of journey.
Okay, thank you. Yes, Yigal.
Just want to mention that in our case, it's very simple. We're a small country. All the companies are global from day one. They think global. They cannot work only for the Israeli market or the area, and they are looking very hardly to make partnership or to make contacts very soon, since they established. And one of the key elements to create the ecosystem in Israel, which is very good now, is to create the network with American funds, American institutions, European ones, and with the Far East as well. We are very successful in this, and now each company that you're going to invest, even if it's the early stage, you talk about, you know, who are going to be the partners in the world and where are we going next stage.
Okay, well that's a good side of the story as well, and it depends a little bit on the size of the country and how big your market is to be able to play around there. A question to all of you, to which extent do you also work with international other investment companies? For example, to create more critical mass, yes or no? Yigal.
Yes, we work a lot with international companies and funds. With the venture capital, it's very simple. You cooperate with other funds because you need to distribute the effort. You need to deal with companies. And secondly, you need a network. You know, since the beginning, when we started EUREKA, the main idea of the government creating this fund was to do it with experts that are already in this business and which are not Israelis. So we brought to Israel many American funds and European funds to work together with us. And the fact that they were engaged in investing in companies created a network, because they took all the companies
Okay.
to
So
try
you had
to...
a wonderful leveraging effect for your country.
Yeah,
Okay.
and this cooperation with funds continue. We have today more than 300 funds investing in Israel, foreign funds, together with local ones.
Okay. Lucy, do you have that experience as well? Do you
Yeah,
work
so-
together with other
Absolutely.
investment parties that focus on sustainability, kind of the same DNA that you're trying to...
Yeah, so we're co-invested with a number of international funds, both that focus on sustainability and some that focus on other things.
Yeah.
There's just overlap within that company. But sort of linking back to the comments made from the previous question, which I couldn't agree with more, the challenges of going into a new market, and one of the great ways of reducing the risk and helping you go into a new market is by co-investing with a local VC in that market. And a big challenge is sort of understanding all those things we talked about and understanding the culture. And if they're on your team helping you do that, then that's a huge positive.
Sure.
And to Yuval's point, the increase in network as well. So it's, yeah.
Okay, good. I'd like to take a final question then from the audience. What sort of returns do venture capitalists tend to look for? That might be a tricky question to disclose here, but...
I don't think it's that difficult. So if you look at a conventional venture capital fund, they're always pitching that they're going to be in, and you can, there's a statistical challenge with this. They're always pitching that they're going to be in the upper quartile of venture capital returns. You can only have one upper quartile. You can't have 4 upper quartiles. And that in Europe, like to be in that kind of bracket, with a conventional multi-LP early stage venture fund, you're probably telling your LPs, who are your investors, that you're going to deliver something like a net IRR of about 25%, which might be over a 5-year time horizon, might be like a 3 times return on your cash. Okay. The interesting thing, though, for an individual company pitching to one of those funds is that if you're saying, I'm going to triple your money, you're almost certainly going to get a response, well, we don't care, that doesn't touch the sides. The reason for that being that a very large proportion, for the sake of just like easy numbers, if we say we invest in 10 companies, our expectation would be that maybe 5 of those do somewhere in between not falling over completely and maybe returning 1x. Maybe 3 of them do a little bit better, return 2, 3x. And then 1 or 2 of them are going to, as you pointed out with your kind of 50x return, 1 or 2 of them might return the whole fund.
Yeah.
This is in the context of very early stage kind of seed and Series A venture capital. The later you go, you have a different risk return profile.
Okay.
And if you look at the maths of that, you probably need every company to have the potential of a 10x plus return, otherwise it's not going to work. If this question was from a founder of an early stage tech company, if you read, there's a couple of very well-known posts that run through venture returns, and there's a book called VC Deals by Fred Wilson, which is every founder asking for venture capital should read.
Yeah. Okay. Lisa, would you agree?
Yeah, I couldn't agree more. I think the statistics change slightly depending on what stage you're getting involved in. So if you're really early stage and the risk is really high, then you really need to believe in the higher multiples. And they can go down a bit as you go further on. But I would say, in general, it's a really good point that you don't want that return to be capped, because that messes up the fund model. So you don't want to believe you can only double your money and that it's capped at that. Yeah. So it's about believing that it could be the big returns. Yeah.
Yes.
Yeah, there's actually a bit of a challenge created in how investment in early stage companies works in the UK, which is that we have a massive tax incentive for the earliest investors in a company, whereby they can instantly at the point of investing offset maybe 30 to 40% of their investment against their tax bill. So the returns that those investors have to make as a result of that tax incentivization are lower than the returns that the next investor that company's gonna need to make. And what it creates is a very, very wide funnel at the top, which is a great thing in many ways. But that you get pinch points very quickly at kind of Series A and beyond when the returns need to be much, much bigger.
Thank you for your elaborate answer. Beverly, your experience?
I think, I suppose what I'm thinking about is what that kind of rolls onto, which is, again, looking at clean growth type companies. We haven't had so many exits. Recently, of course, we had Lion Jump and Sonnen and so on, which has been great news. But those exits have all, been in, let's say, between 50 and 75 million pounds, let's put it that way. And so that then has implications for the fund. If it's promising these 25% IRRs, you can start to kind of calculate, therefore back calculate how many companies you need to invest in and how much money you can put in if you're thinking you're going to get a 50 million pound exit. I think the US probably has a slightly better model here because they'll invest in those companies for longer, and so those exit returns will be much higher, and that then kind of helps the whole venture capital marketplace work in a much more smooth way. I think here in the UK things are slightly broken, and it's incumbent on all of us really to look at, all right, how do we join things up? How do we help some of these entrepreneurs get through to those exits, and how do we hold on to them for that bit longer so that we can really make the 150 million type exits that you were just talking about earlier.
Okay, thank you. I have a final question before we end this panel discussion. I'd like to start with Stephen. Do you have a piece of advice, 1-2 sentences, for the audience that is looking for investors? What kind of advice would you give them?
Going back to pitching, I would be very clear in what your business proposition is, what your market is, and how you're going to achieve it. So don't promise the earth. It's hard to deliver. Okay,
be clear. Yigal.
Well, find the good investor.
Find a good investor. You'll be around the whole day, Yigal?
Yeah.
I'm sure you will. Thank you. Beverly?
Yeah, I think there are a lot of investors in the marketplace, but it's really about looking at who's particularly interested in the type of technology innovation you have at the stage that you have it, and does that investor actually have any money to be able to invest? You can spend an awful lot of time in shoe leather walking about pitching, but is that are you pitching to the right people at the right time?
Okay, thank you.
I think that's a really important point that Beverly just made. And if you can find, if you've got an idea of who those investors are, then don't be afraid to approach them. LinkedIn is an incredibly powerful tool. I try and reply to every message I get on there. But give some context. Give some context when you do approach people, and you should hear back from them.
Okay, thank you. James?
Yeah, just the venture capital industry and pitching venture capital, when it's done best, I think has to be seen as a relationship, not a purely one-off transactional thing. The amount of times we've made really significant investments in maybe a future funding round from a conversation that started 2 years ago. And that happens because you have an opportunity to meet someone. You don't waste their time up front. You might pass very quickly on that first investment, but you genuinely say, look, like, if in a year's time, in 2 years' time, for X, Y, and Z reason we can't invest now, we might be interested down the line. And a lot of those really long-term partnerships and the funds that will end up really fueling your growth over the years, they're relationships. They don't just come from a first meeting going to a second meeting, a third meeting, an investment committee.
Okay, thank you very much. Ladies and gentlemen, a big hand for our panel.